Welcome back to the deep dive. Usually when we grab a stack of reports and articles for an episode, I have a pretty clear picture of what we're walking into.
Sure.
If it's a tech topic, we're talking innovation. If it's true crime, we're talking motive. But today, well, today feels different.
It is different. I mean, we aren't just looking at a crime today. We are looking at a glitch in the human operating system.
That is exactly what it felt like reading this. We are, of
Yeah.
course, talking about Bernie Madoff. And for years, I think I just filed him away in my brain as the Ponzi scheme guy.
Right. Just a generic villain in a suit.
Exactly. But when you actually read the court documents, the psychological profiles, the sheer mechanics of what he built,
Yeah.
it's not just a financial crime. It's a psychological masterpiece.
It really is. It's a story that challenges the very concept of trust. I mean, we're talking about a fraud that prosecutors estimated at $64.8 billion.
Which is a number so big it just becomes abstract. It's almost meaningless.
It is. But think of it this way. That is the GDP of a small country, like a real country. And it wasn't run by some shady guy in a basement printing fake bills.
No.
It was run by a man who was, for all intents and purposes, financial royalty.
That's the core paradox I just can't get over.
Yeah.
This guy wasn't some outsider trying to break in. He was the inside. He was the former chairman of the Nasdaq.
He was the guy regulators would literally call when they needed advice on how to regulate the market. The fox wasn't just in the hen house. He designed the hen house.
Which is exactly why he got away with it for so long. He was the establishment. And I think that's our mission for this deep dive. We need to move past the headlines and really understand the mechanics. How did he actually do it?
Yes. How did the engine work?
Right. And I really want to unpack this split-strike convergence strategy he kept talking about, because half the time it sounds like complete gibberish and the other half it sounds like some kind of secret genius.
And we will break that down. It's actually less complicated than he wanted people to believe, which was part of the trick.
And we have to talk about the psychology. Why did the smartest people in the room, CEOs, celebrities, seasoned hedge fund managers, hand him their life savings without asking the most basic questions?
That's the willful blindness we mentioned. And then there's the other side of it, the aftermath.
The recovery,
Yeah.
which is a twist ending most people don't know about.
Yeah.
Usually in these cases, the money is just gone. Poof.
Pennies on the dollar if you're lucky. In this case, the aftermath is almost as fascinating as the crime itself.
But let's rewind. Let's go all the way back to the beginning. Because the thing that shocked me the most in the research wasn't the billions, it was the lifeguarding.
It's a very humble start, isn't it?
It is. You picture Madoff as this titan born on Wall Street. But no, in 1960, he's just a 22-year-old kid from Queens. He takes $5,000 money he earned lifeguarding at Rockaway Beach and installing sprinkler systems.
$5,000? I mean, today that wouldn't even pay for the ergonomic chairs in a hedge fund office.
Not even close. And he didn't do it alone, right? There was a family connection right from the start.
Absolutely. His father-in-law, Saul Alpern, this is a crucial piece of the puzzle. Saul was an accountant, and he loaned Bernie $50,000 to get the firm started.
A pretty significant sum back then.
It was, but more importantly, Saul had a circle of friends and clients he was trusted, and he started referring them to his son-in-law, Bernie.
So the affinity aspect, relying on a close-knit community, was baked in from day one. It was in the DNA of the firm.
It was. But we have to be really careful here not to paint Madoff as a fraudster from the very first second, because the real tragedy of this story is that he was actually brilliant.
This is the part that gets lost. He built a real business first, a legitimate, powerful business.
A revolutionary business, even. You have to remember, in the 1960s and 70s, if you wanted to buy a stock, it was a manual nightmare.
Right, you'd call your broker.
Who would call a clerk on the floor of the New York Stock Exchange, who would then run a little piece of paper to a specialist. It was slow, it was inefficient, and it was incredibly expensive. The spread, the difference between the buy and sell price was huge.
The old boys club, taking their cut at every step.
Exactly. Madoff looked at this whole archaic system and said, computers can do this better. He was a true pioneer in electronic trading. He used technology to automate the matching of buyers and sellers. His firm helped develop the very technology that eventually became the Nasdaq.
So when people called him a Wall Street legend, that wasn't just PR fluff. He actually built the plumbing of the modern market.
He really did. By the 1980s, Madoff Securities was an absolute powerhouse. They were a massive market maker.
Can we just pause on market maker? I see that term everywhere, but what does it actually mean in practice for a firm like his?
Think of a market maker like a wholesaler for stocks. If you, a regular person, want to buy a share of, say, IBM, you don't necessarily buy it directly from another investor who happens to be selling at that exact second.
Okay.
You buy from a market maker who holds a big inventory of IBM stock. They stand ready to buy or sell at any moment, which keeps the market moving smoothly. They provide the liquidity.
So they're the ones who grease the gears of the whole machine.
Precisely. And Madoff was the biggest grease trap in New York. At one point, his firm was processing something like 5% of the total daily volume of the New York Stock Exchange.
5% of the entire NYSE. That is an immense amount of power and information.
It is. And this brings us to a concept called payment for order flow. This is a bit technical, but it's absolutely key to understanding his good guy image. Madoff would actually pay other brokerage firms, like the Charles Schwabs of the world, a penny a share to route their customers' orders through his firm.
Wait, hold on. He paid them to let him execute the trades? Why would he do that?
Well, critics called it a legal kickback. But Madoff's argument was that he was so efficient, he could still make a profit on the tiny spread while giving the customer a better price. He framed it as being on the side of the little guy.
That is a masterstroke of camouflage. He wraps himself in the flag of democratizing finance.
All while planning the biggest theft in history. And this duality, this split personality, it was physical, it was architectural.
You're talking about the lipstick building.
The infamous lipstick building in Manhattan. If you were a client or a business partner visiting Madoff Securities, you'd go to the 19th floor.
Okay.
And that was the legitimate market-making business. It was run by his sons, Mark and Andrew. It was high-tech, frantic, dozens of traders shouting, screens everywhere, a real beehive of capitalism.
And the fraud.
That was on the 17th floor.
Just 2 floors down.
But it was a different universe. It was quiet. The blinds were always drawn. There were fewer than 24 employees to manage tens of billions of dollars.
That alone should be a red flag the size of a bus.
It should be. And the technology was ancient. They were using old IBM AS400 computers from the 80s that printed out fake trade confirmations on dot matrix paper.
Dot matrix. The kind with the holes on the side.
The very same. So they'd look authentically old. And the sons, Mark and Andrew, they ran the 19th floor. Did they ever go down to the 17th?
I'm guessing no.
They don't have key cards. Madoff kept the asset management arm, the so-called hedge fund side, completely siloed. He told his sons, his own family, I handle the investments. That's my secret sauce. You handle the market making.
That is compartmentalization on a sociopathic level. I mean, usually in a family business, you want your family involved in the core of it. He literally locked them out of the engine room.
And that secrecy should have been the biggest red flag of all. But because he was Bernie Madoff, the legend, people just accepted it as well as eccentricity. Oh, that's just Bernie being Bernie.
Okay, so let's talk about that secret sauce. Because he had to tell investors he was doing something to generate these returns. He called it the split strike conversion strategy.
Or the collar. Same thing.
It sounds so technical and oppressive, but in plain English, what was he claiming to do?
Okay, let's visualize this because the strategy itself is actually legitimate. It's a real conservative option strategy.
Yeah.
Step 1, you buy a basket of blue chip stocks, the big, boring, stable companies in the S&P 100. Think GE, Coca-Cola, Procter & Gamble.
Right, so I actually own the stock.
Step 2, you are worried the market might crash, which would hurt your portfolio. So you buy put options on the index. A put option is basically an insurance policy. It gives you the right to sell your stock at a specific, predetermined price, even if the market drops to zero.
So I'm protected on the downside. I can sleep at night.
But insurance costs money. Buying all those puts is expensive. It eats into your returns. So, step 3. To pay for that insurance, you sell call options.
Selling a call. Okay, that means I'm giving someone else the right to buy my stock from me if the price goes up to a certain level.
Exactly. You are capping your own upside. If the market skyrockets, you don't get those huge explosive gains because you're obligated to sell at that agreed upon price. But the money you get from selling that call option pays for your put option, your insurance.
So you've created a collar around your returns. You can't lose much, but you can't win big either. It smooths everything out.
Precisely. In theory, this strategy should produce steady, moderate returns with very low volatility.
And that matches the story Madoff was telling with his returns, right?
It matches the character of the returns perfectly, but not the actual numbers or the consistency. Madoff was reporting returns of roughly 10 to 12%, year in, year out, like a metronome.
Which is good, but it's not, I just won the lottery good. And I think that's where people get confused. Usually Ponzi schemes are promising 50% returns in a month, something obviously ridiculous.
That's the absolute genius of it. The typical Ponzi scheme appeals to naked greed. Give me your money and I'll double it by Tuesday. Madoff appealed to fear. He appealed to the desire for safety and security.
He wasn't selling a rocket ship, he was selling a bunker.
Exactly. Investors looked at his performance chart, and it was a beautiful, smooth line going up at a near-perfect 45-degree angle. It barely wiggled, ever. In November 2008, when the global economy was in complete meltdown, the S&P 500 was down 38% for the year. Madoff's statements reported that he was up 5.6%.
That consistency, I mean, looking back, it's so obviously impossible. Markets just don't move in straight lines. But at the time, why didn't that set off more alarms?
For some people, it did. We'll get to that. But for his victims, they viewed it as the perfect investment. It was like a bond that paid equity-like returns. It was the sleeping pill investment. You put your money with Bernie, and you didn't have to worry about the next market crash.
So that was the pitch. But how did he get them in the door in the first place? You mentioned the Jewish circuit. This is the affinity tribe part of the story.
This is where Madoff played a psychological game that was miles ahead of any other con artist I've ever studied. He utilized rejection marketing.
Rejection marketing? What's that?
He played hard to get. He worked the exclusive country clubs in Long Island and Palm Beach. If a wealthy CEO or a doctor came up to him at the golf course and said, "Bernie, I'd love to invest $1 million with you," Madoff wouldn't say, "Great, where's the check?"
What would he say?
He'd say, I'm not really taking on new capital right now. Or, I don't know, I don't think you're the right fit for what we're doing. Or sometimes just a simple no.
That is incredibly bold.
It's seductive. If you tell a master of the universe, a person used to getting whatever they want, that they can't have something, what do they immediately want more than anything else?
They want in. It becomes a velvet rope. It's a club they have to join.
It became the ultimate status symbol in those circles. I invest with Bernie. It meant you were in the inner circle. It meant you were sophisticated and connected. And because he was one of us, a prominent member of the Jewish community, a major philanthropist, a family man, the critical thinking part of the brain just shut off.
The trust replaced the need for verification.
The thinking was, Bernie wouldn't screw me. I see him at the club every Saturday. Our wives play bridge together. He's on the board of Yeshiva University.
But it wasn't just individuals, right? I mean, $64 billion didn't just come from dentists and retirees in Palm Beach. There had to be an industrial pipeline.
The feeder funds. This is the mechanism that allowed the fraud to scale from a regional scam into a global catastrophe. You had these massive hedge funds, Fairfield Greenwich Group, Tremont Group, Bank Medici in Austria, that were essentially set up to be giant funnels for Madoff.
So I give my money to, say, Fairfield Greenwich, thinking they are these brilliant managers doing their own research.
And they take a massive management fee, usually 2% of assets and 20% of the profits, and then they just turn around and hand all the cash to Bernie.
They were just middlemen. That's all they did.
Highly, highly paid middlemen. Fairfield Greenwich alone had a $7.5 billion exposure to Madoff when it collapsed. They were making hundreds of millions of dollars in fees for doing absolutely nothing but passing along Madoff's fake statements.
So they had a massive financial incentive to just shut up and not ask any questions.
It's the definition of willful blindness. If you start digging into how Bernie gets these amazing returns, the gravy train might start. So you don't dig. You accept the one-page statements. You accept the secrecy. You cash the checks.
But not everyone accepted it. This is my favorite part of the story. The one guy who actually sat down and did the math, Harry Markopolos.
Harry Markopolos is the Cassandra of this whole Greek tragedy. He was a quantitative analyst, a math guy, at a rival firm called Rampart Investment Management.
Okay.
So in the year 2000, a full 8 years before the collapse, his boss throws a Madoff performance chart on his desk and says, replicate this. Make us a product that does what Madoff does. Our clients are asking for it.
Copy the master.
So Harry sits down, he looks at the strategy, the split strike conversion, he looks at the returns, and he said later that within 5 minutes, he knew it was a fraud.
5 minutes? How could he possibly know that fast?
It was the math. It was just the basic math. Specifically, it was the volume of options traded. Remember, Madoff's strategy required buying puts and selling calls on the S&P 100 index.
Right.
Markopolos looked at how much money Madoff was supposedly managing at the time. Then he looked at the public data for the total number of S&P 100 options that existed and were traded on the entire Chicago Board Options Exchange. The numbers didn't just not match up, they were on different planets. For Madoff to execute that strategy for that amount of money, he would have needed to buy more options than existed in the entire world.
Wait, let me get this straight. So even if Madoff bought every single option on the market, he still wouldn't have had enough to run his strategy.
Not even close. At times, his supposed positions would have been 7 or 8 times the size of the entire global market for those options. It's like saying I own 10 houses on a street that only has 1 house. It's not just unlikely, it's a logical and physical impossibility.
So Markopolos realizes, okay, this guy is lying about what he's doing.
He concluded it could only be one of 2 things. Either Madoff was front-running, using his legitimate market-making business to peek at client orders and cheat, or it was a giant Ponzi scheme. He bet heavily on it being a Ponzi.
And he didn't keep this to himself. He wrote a memo, right?
He wrote several. He was relentless. The most famous one was in 2005, which he sent to the SEC. The title was, and I love this, "The World's Largest Hedge Fund is a Fraud."
Subtle. No room for misinterpretation there.
None. He sent it to the SEC. It was 17 pages long. He listed 30 specific red flags. Another one was the equity curve itself, that smooth 45-degree line. He compared it to a baseball player batting .966 for a whole season, when batting .300 makes you an elite all-star. He practically drew them a map to the body.
And this brings us to the most infuriating part of this whole story, the regulatory failure. Because you have a credible whistleblower waving a giant red flag, you have impossible math. And the SEC does what?
They didn't just do nothing. They investigated him and cleared him. The SEC looked into Madoff at least 8 times over a period of 16 years.
8 times. 8 separate investigations, and they never found the smoking gun.
They never even looked for the gun. This is a story of, frankly, incompetence and regulatory capture. First, the incompetence. Markopolos testified later that the SEC staff he met with simply didn't have the financial literacy to understand what he was telling them.
They were lawyers, not derivatives traders.
Exactly. They were looking for legal technicalities. Is he registered properly? Are the disclosure documents filed correctly? They weren't equipped to check the actual trading data. Markopolos said it was like trying to explain nuclear physics to a toddler. They didn't get it.
And then there's the capture part. Because the relationship between Madoff and the SEC wasn't exactly adversarial, was it?
It was incredibly cozy. Madoff had served on advisory committees for the SEC. He was seen as a peer, an industry statesman, and then there's the romance.
The romance.
Shanna Madoff, Bernie's niece, and, get this, the firm's compliance officer, married a man named Eric Swanson.
And who was Eric Swanson?
He was a high-level assistant director at the SEC's Office of Compliance Inspections and Examinations, the very office that would have been investigating his future uncle-in-law.
You have to be kidding me. The guy in charge of inspecting the firm marries the compliance officer of that same firm.
Now, to be fair, Swanson claimed he recused himself from any Madoff-related matters once the relationship began. But the optics are just catastrophic. The social mixing, the family ties, it creates a halo of protection. A junior investigator is not going to want to go hard after the uncle of their boss's wife.
It's human nature. You assume the people in your social circle and your family are the good guys.
But the single biggest failure, the one that made the entire fraud possible, was a really boring procedural loophole. And this is the detail that actually matters most. Madoff acted as his own custodian.
Okay, unpack custodian for us. Why is that so important?
In a normal, legitimate hedge fund, there is a strict separation of powers. The fund manager, the person making the decisions, decides what to buy. But a large, independent third-party bank, like a JP Morgan or a State Street, is the one that actually holds the assets and executes the trades. They are the custodian.
So if I'm a fund manager and I say I bought 1 million shares of Apple stock, the bank is there to confirm, yes, we are holding 1 million shares of Apple stock for him.
Exactly. It's an independent third-party check on reality. But Madoff told the SEC, look, I'm a big broker-dealer too. I'll just keep the assets myself. I'll be my own custodian.
He was grading his own homework.
For decades, he was the manager, the broker, and the custodian all in one, and the SEC just let him do it. They never once, in all those investigations, simply picked up the phone and called one of the supposed counterparties to say, hey, did Madoff actually buy $1 billion of treasury bills from you yesterday?
And if they had made that one phone call,
the whole thing would have collapsed in 5 minutes, because the answer would have been, who? We have no record of that trade. But nobody ever made the call. And so Madoff kept spinning the plates until 2008. The Great Recession. Gravity always, always wins in the end. A Ponzi scheme is like a shark. It has to keep moving forward or it dies. You need a constant stream of new money coming in to pay off the old investors who are leaving.
But in 2008, the music just stopped. Everyone stopped investing.
Not only did they stop investing, the market crashed. Investors were panicked. They were losing money everywhere else, so they needed cash. And they started sending redemption requests to their safest investment, Bernie Madoff. Give me my money back.
A classic bank run.
A massive, massive run on the bank. In late 2008, clients tried to withdraw about $7 billion from the fund.
$7 billion. And how much did Bernie actually have in the bank account?
In the Chase Manhattan bank account where all the client money sat. Maybe a few $100 million. $200 or $300 million on a good day.
$7 billion in withdrawal requests, a few $100 million in the bank. The math is finally, undeniably catching up to him.
He was completely and utterly finished. He tried to scramble. He tapped his 95-year-old friend, a man named Carl Shapiro, for a last-minute infusion of $250 million.
He took $250 million from a 95-year-old friend, knowing it was just going into an incinerator.
Knowing it was gone the second it hit the account, it bought him a few more days of breathing room. And this leads to the endgame, December 10th, 2008.
The bonus checks.
Right. Madoff, knowing the end is near, decides he wants to pay out about $170 million in bonuses to his key employees and family 2 months early. He wanted to distribute the last of the cash before the whole ship went down.
And his sons, Mark and Andrew, who run the legitimate side of the business, they saw this and finally asked the question they should have asked years ago.
They came to him and said, essentially, Dad, we're sharing, we can't pay investors. We're scrambling for cash. How on earth can we be paying out $170 million in bonuses? They demanded a real explanation.
And he couldn't spin it anymore. The lies had run out.
He took them to his apartment, he sat them down, and he said the words that ended in Mara. It's all just one big lie.
One big lie. Just like that.
He called it a giant Ponzi scheme. He said he was finished, that he had nothing left.
I just try to imagine that moment. For Mark and Andrew Madoff, they spent their entire lives idolizing this man. They work for him. Their name, their entire identity is tied to this firm. And in one single sentence, their entire reality just dissolves.
And this is a major point of contention. Some people still believe the sons must have known something. But the FBI and the prosecutors, after years of investigation, eventually concluded they didn't. And their reaction that night supports that theory.
What did they do?
They didn't help him hide the money. They didn't flee the country. They left the apartment, went straight to their lawyers, and the lawyers immediately called the feds.
They turned in their own father that night.
The very next morning, December 11th, the FBI knocks on the apartment door. Bernie answers in his bathrobe. According to the agents, he was calm, resigned. He knew it was over. He admitted there is no innocent explanation.
And just like that, the illusion shatters.
And the real-world devastation begins.
We have to spend some time on the human cost. Because when we say $64 billion, it's just a statistic. It's too big. But the list of victims, it's just heartbreaking.
It is. You had, the little guys, the grandmothers, the teachers, the mechanics, who had trusted their entire life savings to Uncle Bernie because a friend or a cousin vouched for him. They were wiped out completely. Some lost their homes.
And then there were the charities. The ripple effect was enormous.
The Elie Wiesel Foundation for Humanity. Elie Wiesel, the Nobel laureate and Holocaust survivor, his foundation lost $15.2 million. He and his wife lost their personal savings as well. He called Madoff a scoundrel, which for Elie Wiesel is pretty strong language.
Steven Spielberg's Wunderkinder Foundation was hit. Yeshiva University lost over $100 million.
The money he stole wasn't just funding yachts. It was supposed to be funding cancer research, education, and aid for the poor. But the darkest toll, of course, was the suicides.
Yeah, this is the part that is just hard to talk about.
René Thierry Magon de la Villouche. He was a French aristocrat, a respected and brilliant fund manager. He had invested his own money, his family's money, and all of his clients' money. Virtually everything with Madoff. He believed in him completely. He'd staked his entire reputation on him.
And he felt personally responsible for the ruin of his friends and his family. A few weeks after the scandal broke, he locked himself in his office in New York, and he took his own life.
And William Foxton, a decorated British soldier?
Lost his entire family's savings, shot himself. And then the final tragedy of the story, Mark Madoff, Bernie's son, the one who turned him in. He was never charged with the crime, but the public hatred was intense. The lawsuits were endless. He couldn't escape the taint of his father's name.
He was a pariah.
Completely. And 2 years to the day after his father's arrest, December 11, 2010, Mark hanged himself in his Soho apartment. His 2-year-old son was sleeping in the next room.
It's just biblical. The sins of the father. It destroyed the entire family. It's a complete wasteland.
Madoff, from prison, said he cried for weeks when he heard. But Judge Denny Chin, at the sentencing, didn't show much mercy. He called the crimes extraordinarily evil.
And he gave him the maximum sentence, 150 years, which was symbolic, obviously. He wanted to ensure that Bernie Madoff would die in prison, and he did in April of 2021.
Now, usually in a story like this, that's the end. The bad guy goes to jail, the money is gone, the victims are left destitute, roll credits. But the Madoff story has this twist in the final act that is honestly surprising and not widely known.
The recovery.
Enter a man named Irving Picard.
The trustee. Irving Picard was the lawyer appointed by the court to liquidate the firm and try to get some money back for the victims. Now, in a typical Ponzi scheme, victims get pennies on the dollar, maybe 5 cents, 10 cents if they are incredibly lucky. The money has been spent on yachts and mansions and just disappears.
And Madoff did spend money, but he couldn't possibly have spent $64 billion.
Exactly. But Picard did something very aggressive and very controversial. He went after the net winners.
Okay, this is a concept we really need to explain carefully because it made a lot of people absolutely furious. What is a net winner?
Okay, let's say you invested $1 million with Madoff back in 1995. Over the next 10 years, Madoff sends you these wonderful statements saying you made great profits. So you withdraw $2 million to fund your retirement, buy a beach house, pay for your grandkids' college education.
So I put in $1 million, I took out $2 million. As far as I know, I'm a successful investor.
Then the crash happens. Irving Picard's office knocks on your door and says, that $1 million in profit you took out and spent, it wasn't real profit, it was stolen money. It was the principal investment of the person who put their money in 2007. You have to give it back.
Wow. So even though I had no idea it was a fraud, I am legally obligated to repay money I may have already spent years ago.
That's the clawback. The legal theory is called unjust enrichment. You cannot be allowed to profit from a crime, even if you were an innocent beneficiary of that crime.
I can only imagine the anger. People must have screamed, I'm a victim too. I thought that was my money. I lost my initial investment too.
It was a brutal, brutal legal battle for years. But the courts ultimately sided with Picard. And he didn't just go after the little net winners. He went whale hunting.
The estate of Jeffrey Pickauer.
Jeffrey Pickauer was a billionaire investor from Florida who had been with Madoff for decades. He had withdrawn billions more than he put in. We're talking about statements that showed returns of up to 950% in some years.
950%. And he didn't ask questions. That's not just a red flag. That's a whole fireworks display.
Picard's team argued that he must have known, or at the very least should have known, that these returns were impossible. After Pickauer died, his estate settled with the trustee for $7.2 billion.
$7.2 billion. That is the largest single forfeiture in United States history.
It is absolutely staggering. Picard also went after the banks. He got roughly $2 billion from JP Chase for failing to file suspicious activity reports. He argued that the bank saw the bizarre cash flows, saw all the red flags, and just looked the other way because Madoff was a profitable client.
So when all the dust settled from all these lawsuits and clawbacks, how much did they actually get back for the victims?
As of late 2020, they had recovered over $14 billion in cash.
Which sounds small compared to the $64 billion number, but
You have to remember, the $64 billion figure included all the fake profits on the statements. The actual cash that people invested, the principal, was estimated to be about $17 to $19 billion.
Huh.
Picard recovered roughly 76% of the approved claims.
76% recovery. That is practically a miracle in the world of financial fraud.
It is completely unheard of. If you were a net loser, someone who lost your principal investment, you got almost 3/4 of your money back. It took a decade, but it happened.
It's a testament to the power of a relentless trustee. But it doesn't erase the trauma or the lost time.
No, money doesn't bring back the years of stress, the sleepless nights, or the lives that were lost.
So bringing this all home, why does the Madoff story still matter so much? It's been well over a decade. Why are we still obsessed with it?
Because the vulnerabilities he exploited are timeless. They are fundamental glitches in human nature. The first and most important lesson is about affinity.
We trust people who are like us.
We lower our guard when we are in our club. And that club could be a religious group, a social circle, an alumni network, or even an internet forum. Madoff proved that your shared background is not a substitute for due diligence. In fact, that's exactly where the wolves hide in sheep's clothing.
And the lesson about the too good to be true rule.
It's the straight line, the 45-degree angle. Listeners, if you look at your investment statement, your performance chart, and it looks like a smooth, perfect line going up while the rest of the world is jagged and chaotic, run.
Volatility is the price you pay for performance in real markets.
Exactly. If someone claims to give you stock market returns with bond market safety, they are lying. Period. That financial product does not exist.
And finally, the failure of the gatekeepers. We can't just assume the SEC or the big banks are protecting us.
It's systemic blindness. The experts, the banks, the regulators, they all missed it or looked the other way because they were looking at the man's reputation, not at the math. You have to be your own advocate. You have to ask the hard questions.
Here is a final provocative thought to leave you with. Madoff confessed that the Ponzi scheme started in the early 1990s, but investigators who looked at the very old paper records think it might have started way, way back, maybe even in the 1970s.
Which raises this really haunting question. Was any of it ever real?
Did he ever execute a single legitimate trade for an investment client? Or was the entire 40-year career, the Nasdaq chairmanship, the tech innovation, the legend, was it all just one massive long con to build the credibility he needed to pull off the final theft?
And if the 2008 crisis hadn't happened, if the market hadn't crashed and triggered that bank run, how much longer could he have kept it going? He might have died a hero. His sons would have inherited a lie, and the fraud might have outlived him.
That is a terrifying thought. Check your statements, people. Don't trust, verify. Thanks for listening to The Deep Dive.